What do you make of the number this morning? It was better than expected. Does it tell you the economy may have another gear in it, that it can run a little hotter than we previously thought?
Well, the number is about what we expected, to be honest, and we still think things are going to slow down this year. Upcoming, we think things will be about 2.7% growth instead of 2.9% this year. And after that, we think the stimulus that we're getting from the tax cuts and spending are going to start to fade.
In that sense, though, I know you don't like to be political, but you are at odds with the administration, which believes the effects of the stimulus will keep going. I mean, their story is that you're going to have these tax cuts that will create capital spending, that will create a productivity boom. Do you disagree with that?
Well, I think we do. I mean, it would be great to see that happen. We'd love to see that happen. But we see most of the effects as being stimulative. And stimulus wears out after a while.
What happens to productivity under your forecast, which is so important for the outlook for growth?
Well, we do have productivity picking up. Productivity's been pretty low, and it's still been a bit of a mystery. We do have productivity picking up and moving up into what one might think of as a normal range over the next few years.
Keith, there's been a big debate or an emerging debate in the economics community about how much deficits matter. There was a very important speech by Olivier Blanchard, the former IMF chief economist, and then also in Congress there are people who are saying deficits don't matter. What's your view?
Deficits have an effect. We think deficits, certainly deficits affect flexibility. One of the things I think is really notable is we're having pretty strong growth right now, almost 3% last year. Unemployment rate's low, yet we added about $780 billion to the deficit. And that's very good times. When things turn less good, we're going to see the deficit balloon after that, and I think it'll affect the flexibility of things. And we're starting to spend more and more on interest cost. One of the startling things about the report we just released is over the next 10 years, we think just the cost of paying off interest on debt is going to pass all the defense spending over the next 10 years. So that's going to be a bigger part of the budget going forward.
If it passes defense, it's long past spending on education, right?
That's right.
Let's talk about how worried you are for the finances of this country here on a short-term basis and a long-term basis. I hear we're going to run out of cash sometime by the summertime?
Well, that's right. That's right. And, you know, Treasury could take their extraordinary measures at some point and handle things. They seem to have been able to do that all the time.
But long-term, are you concerned about the finances of the country?
Oh, absolutely. Absolutely. It's one of those things where we're on a course that's very difficult. We think, and we've been saying this for a while, that in the long run that this is unsustainable. Deficits are growing, debt's growing. At some point we're going to break a record, and it's going to get to a very, very high level that we've never experienced before.
And getting back to something we talked about a little earlier, you don't really agree with the administration's contention that you can change potential growth. Your forecast has us, what, coming back down this year towards what you believe to be the growth speed of the economy?
That's right. And the big constraint is going to be our aging population, that we just are not going to have the growth in labor force that we've had in the past. And productivity can get back up to somewhere like its normal range. We think that'll happen. But it's that drag from an aging population that's really going to keep the potential growth down around 2%, I think, in the long run.
And if you had some recommendations for how we should be thinking about fixing this right now, what would be your top three?
Well, fixing it is difficult. You know, one of the things that we've seen is the baby boomers have been really participants in the labor force, and other cohorts, younger cohorts, have not been as big of participants in the labor force as the baby boomers were. And that's just been a pattern, and it continues going forward. So there's some potential to get more people involved in the labor force going forward, but still, that can only have so much effect.
So you're blaming this all on millennials, essentially?
Well, I'm blaming people on not being baby boomers.
What about the issue of immigration? Do you have immigration helping U.S. growth later or hurting U.S. growth?
Well, immigration has slowed down. It slowed down during the Great Recession. And normally what we expect and what we've seen in the past is during recessions, immigration slows, but then it picks back up. It just hasn't picked back up this time.
A big part of your outlook is what happens to interest rates.
Yes.
We've had very low interest rates. Where do you guys plug in? You plug in numbers for your forecast. What happens to interest rates?
Well, we think interest rates will go back up to more normal levels. We think it's going to happen. We've been off of the interest rates. In fact, we're off right now a little bit on the interest rates. But we look at history, we look at the past, we see where interest rates wind up being, and we think they're going to go up significantly over the next 10 years.
If we do another year of 3% growth, are you ready to go back and revisit your assumptions about the growth potential of the U.S. economy?
Well, another 3% will help. One of our points that we make, though, is growth can only do so much. So growth would help. It would help the deficits going forward. But the point I just made about growth, last year we had almost 3% growth, and the deficit grew significantly.
Where are deficits going, Keith, in terms on an annual basis?
And by 2022, we think deficits are going to hit $1 trillion going forward. And we think it's going to hit, after 10 years, almost pretty close to 100% of GDP. So the debt is going to get very, very large. And it's something we're going to have to deal with. And the thing I'm concerned about is the longer you wait, the more draconian the measures you'll need to get things under control.
Under your forecast, how much of our budget every year are we spending, say, 5 years from now, on interest?
Well, right now, we're something around 3% of GDP, but we think it's heading towards something very much higher. We think after 10 years, it's going to be exceeding. I think I've mentioned this just before. All of defense spending, it'll be higher.
So that's 7 or 8% of every dollar we bring in.
That's right.
Will go to paying interest and that's under modest forecasts for interest rates.
That's right.
What about other challenges that are out there for the U.S. economy? Especially, one of the things we try to figure out is the global economic weakness that's out there. How do you factor that into your forecasts?
Well, that does factor in, and the global economy makes a big difference. It affects our exports and our imports, and certainly has an effect on interest rates. Right now, we're able to borrow a significant amount of money internationally to keep interest rates low. That doesn't have to continue going forward, and that could have an impact on interest rates.